Namaste.
Welcome to Impact Travelogue by Harmony Inc. At Impact Travelogue, we bring stories of change makers at the grassroots who are solving for sustainability challenges and also impact leaders who are building capacities at not only civil society organization level but also the India Inc. We have one such leader with us, Mr. Shankar Venkateswaran, who's operating partner and head ESG at 𝗃𝘀𝘀𝘁 Investment Advisory Private Limited. Thank you, Shankar, for joining us in this conversation. So, Shankar, post COP26, we've seen that a lot of commitments by companies and by countries on, being net neutral, having a target defined. But as you know, there is a dichotomy also in a developing country. It's not very easy to get into the space very quickly, especially when you have largely your energy mix is still 80% dependent upon coal. What is your take on it?
We were under pressure to commit to a net zero. And I think, so the Prime Minister made that announcement. It is the fact of coal is a reality. And I think it's not just about energy security, which is a big part of it, because we want to be independent of others. Right now we are, for example, all our petroleum, we are dependent on what happens outside, and that causes inflation. So energy security has always been a big issue for India. But I think with coal, it's more complicated than that. I think with coal, the problem also is that you have millions and millions of people, and I don't think there's enough good data on it, who are dependent on coal as a livelihood. Right. So not only coal miners, for which we have some good estimate, but there is also a lot of informal sector involved in coal mining. And then there's a whole ecosystem that supports the mining activities. So when you're talking about getting out of coal, what happens to them? And this is the whole agenda which is called the just transition agenda. How do we transition out of a fossil fuel economy into a non-fossil fuel economy, but in that process ensure that people who get negatively impacted are also taken along and not just dropped. And I think for us, that's a big part of why we need to be careful about getting out of coal. Coal has to go, that we are agreed. I think the question is not whether we need to get out of coal. The question is, how do we transition in a manner where we provide justice to those who are going to get impacted when coal goes away. And I don't think there's enough effort, enough thought being spent in India on that. It's just beginning to happen. On how are we going to do this transition? How will we ensure it is going to be just? Because the people who get impacted, are the poor, and who cares, right? So that's how it is. So that's, to my mind, the big part of this whole question around coal.
Okay. There's a lot of capital pouring in. I mean, we see that, there are investors committing to it. I think USD, some $30 trillion have been committed to achieving climate finance target. But then, when it comes to, raising funds, especially corporates when they raise funds, and I've seen it for myself in the industry, there's a challenge, in terms of the cost of funds. They want to get into renewable space and they want to do, these initiatives around even social peace. But then they feel that, these funds are costlier, and when they start borrowing from the retail market, it's much cheaper. Then how do you convince the management to take on these objectives and achieve the targets?
So, I think the cost of funds is just one of the deterrents. But I think when a company takes a call on this, it must look at it more holistically. What are the benefits of trying to do that? And I think it depends on company to company for sure. But if you're in a business that where an investment today in a high let's say carbon intensive technology is going to commit you to that for 30-35 years, as happens, for example, if you're doing a steel plant or you're doing a power plant, then the calculation becomes very different, right? Because you know that very soon this is going to not be acceptable, your products are not going to be acceptable, and so on. So I think the calculations are complicated. But again, when we look at the financing, we need to understand that there are two aspects to it. One is in the form of investments and one is in the form of lending. When it comes to lending, you're absolutely right that the cost of funds when you want to borrow is for a green project may be higher at the moment. But I think it's a matter of time before that gets equalized. Secondly, and there is also a need for blended finance for sure. So there has to be a mix of grant and commercial finance. And I think policy and everything else needs to enable that blending to happen in a more in a comprehensive manner. But if you look at just investment funding, funding that goes into equity, those are that's a big part of this 130 billion dollars you're talking about, and those are anyway saying, okay, let's invest in things that are low carbon, zero carbon, zero pollution, zero human rights violations. In other words, that follow the sustainability agenda, and they're doing this. And let's not kid ourselves about this fact. They're not doing this out of goodness of heart. They are just saying, seeing this as risk to their investments. And they're saying that if they want to de-risk their investments, they better invest in these kinds of companies and these kinds of technologies. It's as simple as that. And they know that if they don't do this, their own investments are going to probably be at risk. So therefore, they're making these investments. So the investment community is which, and especially parts of the investment community which are more long-term in nature, see this very much as the way forward. And so I would argue that if a company wants to expand and grow its footprint, and it's looking, and it would do that from a mix of equity and debt, it would be better off trying to do that to be sustainable, because that's how the equity will get attracted, and then the debt will follow soon after that.